Welcome to this IEA webinar. My name is Mariano Berkenwald, and today I'll be introducing you to some of our work on energy prices and tax statistics, one of our most requested statistical deliverables. This webinar will present some key statistical concepts that are at the center of our work and will allow you to understand and interpret the data we produce better. We'll start with a short introduction on the topic of energy prices and taxes, focusing on their relevance and importance. We'll then move on to some key statistical concepts, namely end-use prices and some notes about data comparability. Everyone seems to be talking about energy prices and taxes. Just open any newspaper and you're very likely to find articles on this subject. Here is a selection of recent media articles on the subject from around the world. As you can see, energy price movements often make the headlines, and particularly so for crude oil prices. Energy markets have been global for quite some time now, and none more so than crude oil. This graph is from the OECD fact book and is based on data from our energy prices and taxes database. As you can see, crude oil prices can be linked to major world events. This can range from fundamental structural changes in the world economy, such as the growth of demand in China, to political decisions, such as the Arab oil embargo in the 70s, or even meteorological events like Hurricane Katrina in 2005. Energy prices vary over time and across countries. The retail price of motor fuels, for example, depends on a variety of factors, including government policy. An example of this is the fact that consumers in the Netherlands paid almost 7 times more for gasoline than in Saudi Arabia in 2016. Saudi Arabia, as you know, is a large oil exporter and chooses to subsidize fuel prices for domestic consumers. Prices also vary over time, and oil product prices tend to change more quickly than other energy products. You probably remember that in 2014, crude prices dropped dramatically. This has had different impacts in different countries. Between the first quarter of 2014 and the fourth quarter of 2015, when crude oil prices dropped the most, gasoline prices in the United States fell by a third. However, in Sweden, the price decrease was more moderate, around 20% during this period. The reason for this difference has to do with how countries tax energy use. The US typically sets low taxes on fuel, whereas Sweden sets higher taxes. At this point, you may be wondering why countries choose to tax energy. In the words of Benjamin Franklin, there are 2 things that are certain in this world: death and taxes. But why would governments tax energy? They mainly pursue 3 objectives. The first one is revenue raising. Studies have shown that energy demand is relatively price inelastic in the short term. Even if prices increase, we still have to go to work, keep our homes warm, and cook our meals. This makes us a good target for taxation. The second reason is to internalize costs to compensate for harmful secondary effects linked to energy use, like emissions of pollutants or environmental and health problems that are secondary effects to how we use energy. If we set a tax to account for this, the governments can finance what we need to remediate those consequences. The third reason, which is increasingly important, is to send a market signal designed to drive change in energy consumption patterns. In the long run, if petrol prices are high, you will probably consider buying a more fuel-efficient car and therefore limit your consumption. If a government chooses to set differential taxation on different products, you can incentivize the use of certain cleaner fuels. On the right-hand side of the slide, you can see a graph from the OECD Center for Taxation Policy showing how the effective tax rate on energy varies across OECD countries. As you can see from the graph, taxes in Europe are generally higher than in North America. Energy is a significant expenditure at many levels. As individual consumers, energy can represent a major part of our budget, depending on where we live. For example, in 2013, Slovenes spent over 15% of their total household expenditures on energy. This is very considerable. Electricity represents around 40% of total production costs for aluminum. So if an aluminum smelting plant is located in a country with cheap electricity, it'll be more competitive compared to a country where electricity prices are higher. This makes a big difference in the industry. Lastly, it is estimated that spending on energy represents around 8 to 10% of a country's GDP. So energy is a major expenditure at all levels. I hope I convinced you about the importance of energy prices in our lives and in the global economy. But let's move on to the second part of this webinar. In this section, we'll talk about two of the main statistical concepts that are key to our understanding of energy prices and taxes. First, let's talk about the concept of end-use prices. The first thing we should note about energy prices is that prices vary by fuel. We all know that diesel prices are not the same as prices for gasoline, but they also vary by consumer sector. For instance, industries usually pay a lower unit price for electricity than residential consumer, and also they vary over time. The IEA collects and publishes end-use prices for energy, which are meant to represent the real average unit price paid by a certain consumer category over a period of time. We mainly focus on quarterly and annual prices. End-use prices should include all sectoral consumption, and also include all taxes and levies that are not refunded to consumers and that affect the price that is effectively paid. They represent the real economic cost of a unit of energy for these consumer categories. The IEA works with a model for energy prices which has two levels of disaggregation. On a first level, we separate two main components of the end-use price. The first component is the ex-tax price. The second component is the total tax. The total tax is further subdivided into two kinds of taxes. The first one is the excise tax, and the second one is the value-added tax. In the next couple of slides, we'll have a look at these components. First, let's start with the ex-tax price. What is it? Ex-tax prices cover all costs before the product reaches a consumer. Basically, it's everything except taxes. I'll give you an example. If we're talking about a liter of gasoline, these include the cost of the crude oil, the cost of processing in a refinery, transporting, the cost for importing crude oil, for example, the cost of transporting the refined product to the suppliers, distribution, and the margins that the distribution and the retail actors make out of this transaction. All of that is included in the ex-tax price. So basically, what you need to know is that for us, ex-tax prices include everything except taxes. The next component is the excise tax. Excise taxes are usually levied on a volume basis. For instance, US dollars per liter for gasoline or diesel, or US dollars per megawatt hour for electricity. And they are mainly the result of government decisions. There are a variety of taxes that are included in our excise tax category, including environmental taxes, CO2 taxes, motor fuel taxes, emergency stock fees, and labor market taxes. An example of this would be in Sweden, which levies a variety of different tax components on energy products. One of them is called the energy tax. An additional one is called CO2 tax, which is proportional to the emissions of a given fuel. And also there's a sulfur tax, which is proportional to the sulfur content of a given fuel. Countries can decide their tax policy independently, and we see a lot of variety in this category. The second tax component is a value-added tax, which is a very specific kind of tax. It is levied on a value basis, which means it is a certain percentage of the price before taxes, and it is the last tax to be added to the total. This means that the base for taxation is the sum of the ex-tax price and the excise taxes. If the VAT rate is 20% in a country, it's 20% of the combination of all other taxes and the ex-tax price. VAT is a consumption tax, and it is refunded to intermediate consumers. We all know that in most places, services, businesses, and industry get refunded for their VAT expenditures, which means that at the end of the day or at the end of the year, industry and businesses do not effectively pay VAT. That is why we consider that it should be excluded from the total prices when we're dealing with sectors that are entitled to a refund. In some countries now, they don't call it the VAT or a value-added tax. They refer to it with some other names such as goods and service taxes, and most of these are equivalent to VAT in the OECD definition. A surprising amount of countries levy VAT. As of 2015, over 160 countries had VAT systems in place, and a further dozen are currently considering implementing it in the near future. That's mainly all countries. So let's see an example of how this works. We'll start, we have two countries, country A and country B. Country A is a country that imports most of its oil products. For instance, let's imagine we're talking about gasoline prices in these two countries. Let's have a look at the ex-tax price in these two countries. In country A, it's 0.6 euros per liter, and in country B, it's 0.4 euros per liter. This is maybe because country B is a producer, whereas country A needs to import and therefore pay a little bit more for the gasoline it consumes. Let's then add the excise taxes, which are also in euros per liter. In country A, this is 0.2 euros per liter, and in country B, it's 0.4 euros per liter. Country B has a more strict taxation policy than country A. So at this point, if you do the sum of the two, 0.6 plus 0.2 equal 0.8, and the same for country B, you get to the same levels. But the VAT rates are different in the two countries. The VAT is 15% in country A and 25% in country B. Now remember that the base for the VAT calculation is the sum of the ex-tax price and the excise tax. Now we use that to calculate the effective VAT amount, also in euros per liter. When we apply 15% to the sum of 0.6 and 0.2, we obtain 0.12. And when we do the same operation for country B, we obtain 0.2 euros per liter. Now that we have calculated the VAT amount and we know the excise tax rate, we can calculate the total tax component, which is equal to 0.32 euros per liter for country A and 0.6 euros per liter for country B. With the total tax and the ex-tax price, we can calculate the end-use price, which is the sum of the two. When we do this, we see that gasoline is actually cheaper in country A than in country B. We see that even if the actual price of the good, excluding all taxes, was lower in country B, due to government policy, the effective end-use price is higher, which is something we find in a lot of OECD countries. Now, some details about our work and some areas we notice can be particularly problematic for energy prices and taxes. The first one is representativeness, which is a key issue we find. In a lot of countries, actually in most OECD countries, the price of energy varies within the country. Subnational entities have the right to set prices and taxes at different levels. On the left-hand side of this slide, you'll find a map of the lower 48 US states where you can see where gasoline is cheaper. Now we see that in Texas and in the south of the US, prices are generally cheaper than in California or the Pacific Northwest. This is due to differences mainly in local taxes. If we have this diversity in prices around the country, how do we calculate the real end-use price for the country? To do this, we have to work with a weighted average that takes into consideration these price differences across the country and also the different consumption levels across the country. Let's see how this works in an imaginary country called Statusland, which has only 2 provinces as opposed to the 50 states of the US. Diesel prices in Eastern Statusland are $0.5 per liter and $1 per liter in Western Statusland. Now, if you were to calculate a simple arithmetical average, you would just say that the average price is $0.75 per liter. But knowing that the diesel consumption varies a lot between the two provinces, it's 500 kiloliters in Eastern Statusland and 100 kiloliters in Western Statusland, we can calculate a consumption-weighted average. And when we do this, we find that the actual average price is $0.58 per liter. So there is a considerable difference between the two, and we feel it's important to try to be as close as possible to the real average end-use price at a national level. This is often difficult to do, especially in countries like the United States that have not only state taxation but also local taxation at the county level, because you would require very disaggregated consumption data in addition to the prices data. And this is very challenging for administrations. An additional point we want to make is the difference between tariffs and prices. This is particularly important for electricity and natural gas, as we often get this question. Now, the way we understand it, prices represent the average rate per physical or energy unit actually paid by consumers, whereas tariffs are fixed rates at which products are sold to a certain consumer category. Now, imagine in our country Statusland, the utility sets electricity tariffs for residential consumers, which look like this. There's a fixed charge of 10 euros per month and a variable charge of 0.1 euros per kilowatt hours consumed. The fixed charge is independent of the actual consumption, whereas the variable charge is proportional to the consumption. If a consumer consumes 150 kilowatt hours in a month, the price he's going to pay is the 10 euros of the fixed charge plus 15 euros for the variable charges. In total, he paid 25 euros. So the price consumer A paid for electricity is 25 euros divided by 150 kilowatt hour, which is equal to 0.167 euros per kilowatt hour. If we had been looking at the tariff, we could have just said the tariff is 0.1 euros per kilowatt hour. So there is a big difference. When we talk about prices for electricity, we want to include all the components, both fixed and variable. And the combination of those, depending on consumption, is gonna give us the actual price the consumer paid. Thanks to the collaboration with over 35 reporting institutions across OECD countries, the IEA can publish updated information on energy prices and taxes on a quarterly basis. This is one of the figures we publish and one of the most important and requested ones in our publications, and it shows the price differences of unleaded gasoline between OECD countries. As we can see, there is a wide variety between the lower end and the higher end. In general, North America pays lower taxes than pays lower prices than Europe, and something you can see in this graph is that in orange you can see the ex-tax prices, and in light orange you can see the tax component. So this also shows you the differences in how countries decide to tax their energy. We now move on to the second statistical concept, which has to do with data comparability. Now, one of the main objectives when collecting data on energy prices is to be able to compare them both over time and across countries, but this requires additional harmonization work. Prices are not directly comparable because we collect prices in national currencies and they are always current prices. They are not adjusted by inflation or anything like that. So there are two items that are important. They are time comparability and international comparability. Now, where I grew up in the year 2000, a can of soft drinks would cost around $1. But nowadays, the can would cost around $17 to $20 for the same product, and it's the same currency. And that's because the value of money changes over time. So to compare prices accurately across time in a single country, we need to take into consideration the fact that there could have been inflation or deflation. So to do this, we need to express them in a common unit. For instance, dollars of 2010. We'll have a look at how that's made in a second. International comparability has to do with the fact that the same banknote, for instance, a 10 euro bill, can have a different value in different countries of the Eurozone, for instance. In one country, you can afford a can of soft drink, whereas in another country with the same amount of money, you can afford a whole meal. So to compare prices across countries, we need to use purchasing power parities that take into consideration these differences. Let's start with time comparability. So in order to compare energy prices over time, we need to correct the nominal values, also called current prices, by using an appropriate price index to deflate the prices. The real price will be the result of the division between the nominal price and a price index. And the choice of a price index depends on the consumer segment we're looking at. If we're talking about residential prices for natural gas, we will use the consumer price index, which tells us the variation of the price levels in the general economies for end-use consumers. If we're talking about electricity prices for industry, we will use the producer price index. So we need a price index to deflate the nominal prices into real prices. Let's have a look at an example. This example is about electricity prices for industry in the US. As I've just said, because we're talking about industry, the appropriate price index to use is the PPI, the producer price index, which is produced on a monthly basis. Now, on the first column of the table at the left-hand side of the slide, you can see the nominal price in dollars per megawatt hour. On the second column, in yellow, we can see the producer price index, which has a base of 2010 is 100, which means that all the price changes are measured from the year 2010. That's just a decision. Countries can choose a different base year or reference year for these series, and it just means that that's the line from which you measure inflation or deflation. When we calculate the real price and we plot the real price and the nominal price, we can see that there's actually a very big difference. If we had not deflated the nominal prices, we would be inclined to say that in 2013's electricity prices for industry were much higher than in the year 2000. They went from 100 to about 150. That's a 50% increase, which is considerable. But when we deflate to take into consideration the general price increase in the economy, we see that prices in the year 2013 are actually very much comparable to the prices paid in the year 2000. So this is a very relevant example to show why it is important to make these adjustments to the prices. Another interesting graph is when we do the same operation for crude oil import costs in the IEA. If we were looking at nominal prices, which are the blue line in this graph, we would tend to say that the peaks we saw around the year 2008, 2009 was the highest oil price ever. But when we calculate the real prices for crude oil import costs, we can see that it was actually pretty comparable to the levels seen in the early 80s. And finally, let's have a look at international comparability. On this slide, you can see electricity prices for households in IEA member countries when converted from national currencies to US dollars using current exchange rates. Current exchange rates do not take into consideration the different price levels across countries. So in this example, you would see that prices in Mexico are around 5 times lower than in Germany. But what happens if we adjust these prices using purchase power parities? We can see that the picture changes a lot, and actually prices in Mexico are around half as much as those in Germany. So it's very important to take into consideration the differences in purchasing power between countries when doing international comparisons. And now about data dissemination for prices and taxes, the IEA publishes a quarterly energy prices and taxes publication, which is available in paper and PDF, and also CD-ROMs and online data services. We also publish a free monthly oil price statistics report, which is available at the link below. And some of our statistics are also reported in the Oil Market Report, one of our flagship publications, which is published every month, and it's an online subscription. If you want to learn more about energy statistics, we have a lot of different resources that can be helpful. You'll find the links below for our Energy Statistics Manual, which is a comprehensive manual and available in 10 languages. You can also visit the IEA Statistics website for a wealth of resources, including our questionnaires, glossary, and documentation related to our data collection methodologies. Also, you can have a look at the United Nations International Recommendations for Energy Statistics, which provide a methodological framework for our work in energy statistics.